Welcome back to Explain the Charts, everyone. Today, September 17th, 2025, we have a critical update on USDCHF, a pair that has just made a significant move. Let's start by looking at the broader market picture and the news driving this action. The overarching theme is a general weakness in the US dollar, primarily driven by expectations of a dovish Federal Reserve. Several reports indicate that the Fed is widely anticipated to cut interest rates today, Wednesday, September 17th. This dovish sentiment has been weighing heavily on the US dollar, pushing it lower against major peers. We also saw mixed economic indicators, including an inline US CPI report and surprisingly weak initial jobless claims last week, which initially fueled these dovish bets. Although a reevaluation suggested a more resilient labor market, the underlying bearish positioning on the dollar remains strong. In contrast, the Swiss National Bank has concluded its easing cycle, with rates already at 0% as of June 19, 2025, after a series of cuts. This means the Swiss franc's trading behavior is now predominantly influenced by the weakness of other currencies, especially the US dollar, rather than active SNB policy adjustments. Bank of America's FX quant signals are even indicating an increasingly bullish outlook for the Swiss franc. Looking at our daily chart now, we can clearly see the impact of these fundamental factors. Since May 2024, USDCHF has been in a pronounced downtrend, dropping from highs around 0.915 down to current levels. This consistent downward pressure reflects the widening policy divergence and shifting investor sentiment. Now, let's zoom into the most recent price action, particularly what happened yesterday, September 16, 2025. The Investing Live report highlighted a critical swing level around the 0.79 handle, expecting buyers to step in there. However, our daily data confirms that USDCHF decisively broke below this key 0.79 support level, closing yesterday at 0.7859. This is a significant event, as a break below a major support level often signals a continuation of the bearish trend and a potential move towards new cycle lows. Switching to the 15-minute chart for a clearer view of this recent plunge. Here, we can observe the sharp decline that occurred throughout September 16th, starting around the 0.794 region and steadily pushing down to the 0.7859 close. This granular detail vividly illustrates the strong selling pressure that overwhelmed the 0.79 support, reinforcing the bearish outlook from the daily time frame. Let's look at the 1-hour chart to understand shorter-term resistance levels mentioned in the news. While the Investing Live report pointed to 0.7970 and 0.7990 as resistance zones last week, the recent drop has put these levels firmly above the current price, turning them into immediate targets for any potential bounce. The previous support at 0.79 has now unequivocally flipped into a strong resistance level for USDCHF. From a short-term perspective, reasons to be bearish are compelling. The decisive break below 0.79, the strong downtrend momentum seen on the 15-minute chart, and the ongoing dovish expectations for the Fed. A sustained move below 0.79 opens the door for further downside toward uncharted territory, as we are at a multi-year low. However, traders should watch for signs of overselling or attempts by buyers to establish a new floor around these lower levels. In the long term, the bearish outlook persists as long as the Fed maintains its dovish stance and the SNB remains neutral. A rally towards the 0.80 handle, described as a major trend line in our news, would require a significant reversal in market sentiment, likely triggered by a hawkish surprise from the Fed or unexpectedly strong U.S. economic data. Right now, such a reversal seems less probable. Recapping the important price levels to watch, the 0.79 handle is now critical resistance, having been breached. Any retest of this level from below would likely be met with strong selling pressure. The current price is around 0.7859, marking a new low, suggesting that this level could act as initial support or a temporary consolidation point. Further resistance lies at the 0.7970 and 0.7990 levels, as indicated by our analysis of the 1-hour chart. Looking ahead, The primary catalyst for USDCHF today will be the FOMC policy announcement. An explicit signal of continued rate cuts or a very dovish tone will reinforce the bearish trend, making a further decline highly likely. Conversely, any unexpected hawkishness or a strong indication that rate cuts might be limited could trigger a short-term rebound, although this scenario is less likely, perhaps a 30% chance. Tomorrow, Thursday, September 18th, we have the latest U.S. jobless claims figures, which could also influence the dollar's direction. If these figures surprise with unexpected strength, it could provide a temporary reprieve for the USD. Traders should also monitor the daily price action for signs of stabilization or continuation. Look for large bearish candles confirming the downtrend, or bullish engulfing patterns around the current lows signaling a potential, albeit perhaps temporary, reversal. Keep an eye on volume as well. A surge in volume on a bearish candle would confirm selling conviction. Thank you for joining us on Explain the Charts for this in-depth analysis of USDCHF. Stay vigilant and trade wisely.